As a trader, there are a few ways that you can enter a trade, and which one you use can actually make a difference in the outcome of a trade, or if you even get involved in the trade in the first place. Certain orders, depending on when used, can cause your position to suffer from slippage. This essentially means that your trading order will get filled at a price different than what you expected. For the most part though, retail Forex traders don't suffer too much from this unless they trade around news releases. For the most part, the slippage is small, if any, in normal market conditions. It really all depends on what happens between pressing the order button and when the order gets filled. Trade entry types, let's look at the market order. This is the most basic way of entering a trade. When you click the buy, sell, or close button on your platform, you are requesting a transaction at the best available market price. The issue with this is that the bid-ask price, it's constantly fluctuating. So if you see a price of $1.34, for example, and you want to enter a buy by pressing buy, by the time the order occurs, price may have gone up or down. If price goes up, you bought more expensive. With down, you got a cheaper price. Limit order entries. These orders are only filled when price reaches the price you have chosen to enter the market at. My broker actually uses the word limit to describe something that actually has two names, which depends on whether you are buying or selling. A buy limit. Once you set these in your broker platform, you have set instructions to buy if the market reaches your price. Limit buys are always set below the current market price. Here, the first yellow line is the low of the bar, and the bottom line is where you would set a buy limit order. If and when price reaches that level, you'll be entering the market long. The sell limit is the exact opposite of a buy limit. Your order to enter the market short is set above current price. The bottom yellow line here is the high of that bar, and the top yellow line is where you have placed an order to short the market if price reaches that level. Now, the positive of setting a limit order is that you'll get filled at the price that you choose or better. But the negative is that price may get close to your set price, but not trade to it. The market will then roll over without you on board. The stop entry order. These are an interesting type of order, and they do have a unique quality about them, and that is that they combine the attributes of both a limit and a market order. They sit in the market waiting for price, but when they execute, they act as a market order, and they suffer from the same issues that those orders have. Think of these orders as the opposite of the limit order. For example, if you choose to enter a market long, setting a buy stop order has you setting an order above the current price, unlike limits where you would set it below the price. Sell stops have the order set below current price. Now below, you set an order to catch a break of the high on a buy stop at the yellow line. It's possible, depending on the market conditions at that time, that you don't get filled until the green line, and that's called slippage. And when you're designing or testing a trading system, keep it in mind, as slippage can have a direct impact on the profitability of your trading system. Now, protective stop orders, one of the most important orders that you should know and use is a stop loss trading order. When in a trade, these are the orders that can get you out if the trade is not doing very well. It can also get you out of profitable trades if you trail a stop behind price to lock in profit. Many traders love the set and forget ability of setting a stop loss order. You are essentially safe in knowing that the risk you can tolerate is protected by a stop order, and you don't have to remain glued to the trading screen. So ensure that you set one the moment you enter a trade. Well, almost protected, because you can still suffer from slippage because of the same issues that stop orders and market orders have. They sit like limit orders, they feel like market orders. As well, depending on your trading instrument, price can actually gap through your stop loss order, bringing you a loss much greater than you'd expected. In designing your trading strategy, it's important to have many details listed, including how you will enter a trade. The differences can affect your expectancy of the system and even turn a winning system into a loser.